Welcome to our podcast for 18th of February. Last week we saw some GDP numbers out from Europe, and quite consistently they missed expectations. Germany, France, Netherlands, they were all below expectations, and that caused the euro to continue its retrenchment from the sort of recent highs it achieved against the dollar. We also had the G20 meeting which took place, and one of the principal focuses of that has been the currency, an area that we've explored consistently over the last few weeks, has seen more volatility in currency, particularly in the yen. We'll take another look at that chart at the moment. Really what the G20 was saying is that there is and will be no currency war out there, which to some extent gave the green light for further weakness in the yen against the dollar. And this morning in trading in Japanese equities, we've seen a further push to the high side, up another 2% this morning, as exporters continue to gain traction from this sort of renewed weakness in the yen, which is assisting their competitiveness abroad. So Japanese equities and short yen continue to be one of the major trades at the moment. The Financial Times this week writing that billions of profits have been made by hedge funds who have exploited that particular trade quite well over the course of the last few weeks. Turning to the week ahead, it is a week where the US markets are closed today. This is President's Day, so looking to the next few days. In terms of equity, InterContinental Hotels we'll discuss shortly as one of our sort of key features. It's been one of our stocks for 2012 and 13. On Wednesday we have the minutes from the Federal Open Markets Committee and UK unemployment numbers, and then on Thursday it's the UK's projected public borrowing figures. Now this number is expected to be quite a big surplus to the UK sector for borrowing, which will be a surprise, and they're talking about £17 billion. However, I would caution from reading too much into that number. There has been quite a large transfer from the QE programme, and the underlying number is still expected to show that borrowings are rising at the moment. So as I say, I think the headline may flatter the government's position here. Also we have numbers on from Walmart on Thursday, and just be aware there was a leaked memo from Walmart which caused their shares to fall by a couple of percent towards the end of last week. It referred to the fact that February's trading so far has been disastrous. Now that may not come through in the numbers this week. We'll see if there's a corrective position in their statement, but Walmart obviously the main bellwether for US consumer spending, so that number will be of interest on Thursday. So let's just take a look at some of the numbers. As we look to this week, Spain, there is thoughts turning to a stimulus programme. They're talking about some tax cuts coming through in 2014 and 2015, but at the same time we'll be talking about the deficit target in Spain. Looks like they may have missed that for 2012, so that will become a feature. Also we have the Italian election this weekend, and we know that Mario Monti is calling for a televised debate. His own position has lacked quite a bit of traction recently, and therefore it's a sort of last gasp effort for him to get himself in front of the other sort of two main candidates for this weekend, including Mr. Berlusconi, and to see whether a televised debate can gain some traction in those final few days for the Italian election. But both Spain and Italy have been benefiting from this chart, which shows that yields continue to suppress on their sort of 10-year bonds. So that's been helpful to markets. In terms of markets themselves, just continue to highlight the fact that volatility is very low at the moment. This chart actually stretches back to 1990, and we're really bumping along the bottom here at the moment. And so it really continues to be a word of caution that whenever markets do get this lack of volatility in them, we often call it a complacency, and when markets suddenly become volatile, they can turn very, very quickly. So we're just watching that number. This is a level that over the course of the last 20 odd years, each time it's hit this sort of level, it often has sort of towards the low end of, or very much on the low end of the range at the moment. So we just need to watch carefully that this complacency period doesn't preempt something a little bit more volatile in the next few weeks. In terms of some of the interesting charts, but coming back to that yen story, this is really since October how the yen has sort of weakened off against the dollar. Really a very significant move there, 78 up to touching 94 at the moment. So very competitive yen starting to come into that chart. InterContinental Hotels, we mentioned this as one of our stocks for the year. This is a company which really owns very few hotels these days. It really earns its money out of managing hotels and franchises. Around about 2/3 of the business is in the US, where certainly revenue per room has been moving up and occupancy rates have been moving up. There is also talk that they may be making some progress on the disposal of the Park Lane Hotel. The talk is of a minimum 200 million, but I think the number will go well higher than that. And talks of maybe a buyback programme from InterContinental Hotels. They have this morning touched £20 a share for the first time ever, so increasing optimism in the shape of that business model. And anyone wants further information on InterContinental Hotels, feel free to speak to your broker for a research note. In terms of other stocks that I think, other charts that I think worth keeping an eye on, I'm continuing to watch situation in the UK where 10-year gilt yields continue to rise. At the moment we're up to touching 2.3% on the 10-year gilt, so that really has sort of pushing up, and that has caused the pound as well. We've seen quite a bit of weakness in the pound against the dollar. It's been coming down towards the 154 level, which over the last 2 years has represented very much the low end of the trading range for the pound against the dollar. So again, that's a chart worth watching. And just final chart, a little bit complicated, but really the thrust of the sort of argument here is that since the beginning of 2013, so it's only a 6-week period, we've seen quite a bit of divergence now between US and European stock markets. US markets, as represented here by the sort of blue, has shown gains of around about 6.5%, but just in the last sort of couple of weeks in February, the green line representing the Euro stocks has really fallen off quite sharply, and we're now down 1% on the Euro stock. So quite a bit of divergence between US and European markets as we enter into 2013.